He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Sorry about the long break, guys, but we're back covering more undervalued, high-quality dividend growth stocks here on the channel. Today, I want to tell you about my latest undervalued dividend growth stock of the week with a market-beating yield, double-digit dividend growth, and the potential that shares are 21% undervalued. This Dividend Aristocrat and soon-to-be Dividend King is one of my best long-term ideas right now for dividend growth investors. Before we get started, please consider giving this video a thumbs up if you get any value out of our content. If you're new here, you can also get access to my real money portfolio and latest buy and sell alerts by joining my Patreon through the link in the pinned comment below. That said, let's dig in. Automatic Data Processing Inc., stock ticker ADP, is a US-based global technology company providing cloud-based enterprise human resources management software and services. Founded in 1949, ADP is now a $103 billion by market cap HR giant that employs nearly 70,000 people. ADP does its business in more than 180 countries worldwide. The company reports results across two segments: employer services, 67% of fiscal year 2025 revenue, and professional employer organization services, 33%. Employer services, the largest segment by far, is where ADP does its bread and butter by providing a comprehensive range of cloud-based HR solutions such as payroll, human resource, benefits administration, attendance, tax filing, and reporting services. Payroll is where ADP really shines, and it's where the company has its key edge. First of all, payroll processing requires specialized software that, once installed, becomes fully integrated and extremely sticky. If the software is working, why make a change, especially when it'd be so difficult to make that change? This service stickiness creates a high degree of recurring revenue for ADP with client retention near 100%. Payroll is a small portion of an enterprise's overall operating expense load, but it's vital to functionality, further cementing ADP's role within any company's ERP. Plus, ADP is the biggest company in its industry, using its clout to gain and retain business. This is all well and good, but payroll processing also has a hidden power. During payroll processing, ADP holds on to client deposits until such time that employees are actually paid. This time delay between ADP collecting deposits and employees taking their money gives the company a short-term cost-effective float. This is a source of capital that ADP can earn a return on top of what it earns from the core business model, which is in and of itself a powerful cash machine. ADP has used this 1-2 payroll punch to grow into the world's foremost HR company, and it's also what explains how and why the company is so incredibly consistent when it comes to revenue, profit, and dividend growth. That consistency is exemplified by the company's track record of 49 consecutive years of dividend increases. This easily qualifies ADP for its status as an acclaimed dividend aristocrat. In fact, it's nearly a dividend aristocrat twice over and about to become a dividend king. The consistency also shows up in the rate, not just the length of dividend growth. Its 10-year dividend growth rate is 12.8%, nearly matching its 5-year dividend growth rate of 12.1%. ADP is almost a lock for double-digit dividend growth year in and year out. It's clockwork. And you layer that double-digit dividend growth on top of the stock's current starting yield of 2.7%. That's a pretty remarkable combination of yield and growth, as one usually has to accept a much lower starting yield in order to access a higher growth rate like this. Not only that, but this yield is 80 basis points higher than its own 5-year average, only adding to the unusualness of the situation. The one knock against the dividend profile might be the payout ratio at 67%. It's elevated, although certainly not worrisome. That said, as a mature company returning most of its free cash flow back to its shareholders, this higher payout ratio is nothing new for ADP, and the company has never expressed any kind of inability to properly manage it. Despite its maturity, ADP remains a dividend aristocrat, growing its dividend at an aggressive rate. This is one of the best overall dividend pictures out there, in my view. As much as that may be the case, though, this viewpoint is based mostly on what's already happened. However, investors must always be thinking about what is likely yet to happen, as the capital today ultimately gets risked for the rewards of tomorrow. Thus, I'll now build out a forward-looking growth trajectory for the business, which will be highly useful when later going through the valuation process. I'll first show you what the business has done over the last decade in terms of its top line and bottom line growth. And I'll then reveal a professional prognostication for near-term profit growth. Lining up the proven past with a future forecast in this manner should give us enough information to roughly gauge where the business could be going from here. ADP moved its revenue from $11.7 billion in fiscal year 2016 to $20.6 billion in fiscal year 2025. That's a compound annual growth rate of 6.5%. It's pretty strong. I usually look for a mid-single-digit top-line growth rate out of a mature company like this, and ADP is more than delivering. Meantime, earnings per share grew from $3.25 to $9.98 over this period, which is a compound annual growth rate of 13.3%. Excellent. What's especially impressive about this is that ADP has been unusually consistent. I don't see a single fiscal year with a year-over-year drop in EPS, not even during the pandemic. The growth is relentless and secular in nature. For those who value extreme consistency, ADP is about as good as it gets. I can't overstate just how blown away I am by ADP's dependable ability to move up and to the right like clockwork. Looking forward, CFRA believes that ADP will compound its earnings per share at an annual rate of 9% over the next 3 years. CFRA sums it up well here, and I quote, ADP delivers steady operational performance with strong retention, but hiring remains cautious with pays per control flattening to 0%, unquote. Regarding that latter point, AI and its evolution will have a lot to say about overall employment trends and ADP success or lack thereof. On one hand, AI quite possibly threatens the very existence of a large swath of jobs, which would result in less payroll requirements and demand. AI could also result in making it easier to develop in-house software. On the other hand, AI can also help ADP internally through cost controls. There's also something to be said about almost all technological advances across history being used to enhance productivity and increase the number of overall opportunities across the economy. To this point, ADP is using AI as an enhancement through continued expansion of its ADP Assist, a generative AI-powered assistant platform. We're still in the early days here, and the jury is obviously still out on a lot of this. However, I'd be keen to give ADP the benefit of the doubt. The company has simply been too good for too long. Circling back around to CFRA's near-term forecast, I think it's quite reasonable, if not a tad conservative, which I'm fine with. ADP's own medium-term guidance calls for 9% to 11% adjusted EPS growth. Taking the low end of that puts us at that 9% mark. Combining that with the 2.5% plus starting yield can put the stock on track for a low double-digit type of annualized total return, in line with management's medium-term guidance for 11% to 13% total shareholder return. Getting that out of a dividend aristocrat with the utmost level of reliability is awfully attractive. Moving over to the balance sheet, ADP has a terrific financial position. The long-term debt-to-equity ratio is 0.6, while the interest coverage ratio is nearly 13. Total cash exceeds long-term debt, and ADP has credit ratings well into investment-grade territory. AA- from S&P, AA3 from Moody's. ADP actually had a AAA credit rating once upon a time, but it lost this when it spun off its dealer services unit about a decade ago. Although it's not quite as impervious as it once was, ADP's balance sheet remains a pillar of strength. Profitability for the firm is outstanding. Return on equity has averaged 76.4% over the last 5 years, while net margin has averaged 18.7%. Return on invested capital is often north of 30%. Even without employing much leverage, ADP is able to generate very high returns on capital due to its high-quality capital-light operating model. What I see here is a wonderful business firing on all cylinders. And with economies of scale, sticky services with deep integration, high switching costs, IP, float usage, and brand reputation, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. Although ADP's industry is fiercely competitive, its status as the clear industry leader with an impeccable reputation for reliability and capabilities does insulate it somewhat. The company has exposure to the broader economy through overall employment levels as employment feeds through into demand for its services. There is now profound uncertainty regarding whether AI turns out to be a friend or foe for the firm. Being an international company, it has exposure to geopolitics and currency exchange rates. ADP has a very concentrated business model after spinning off various parts of the company over the years, resulting in a lot of dependence on its core payroll software. This business has always struck me as having a fairly moderate risk profile, although the rise of AI does muddy the waters a bit. However, the stock's recent 20% plus slide has priced in more risk than usual and created what appears to be an attractive valuation. Stock is now trading hands for a price-to-earnings ratio of 25.4. While this isn't all that low in absolute terms, it's quite a bit lower than its own 5-year average of 30.9. This stock has long commanded a healthy premium, and deservedly so in my opinion, but that premium has all but evaporated in the lack of the recent drop. The price-to-cash flow ratio of 16.3 is also well off of its own 5-year average of 21, and the yield, as noted earlier, is significantly higher than its own recent historical average. So the stock does look cheap when looking at basic valuation metrics, but how cheap might it be? What would a rational estimate of intrinsic value look like? Well, I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This 8% growth rate is as high as I allow for in the model, but I think ADP's remarkable consistency deserves the designation. It's coming up on dividend king status with no signs of slowing down. Based on ADP's demonstrated EPS and dividend growth rates respectively over the last decade, and based on the near-term forecast for earnings per share growth, which is solidly rooted in medium-term guidance out of ADP itself, an 8% mark actually runs on the conservative side. Because we're still in the early innings of AI, which has all kinds of unknown implications, it makes sense to err on the side of caution. Still, in almost any type of ordinary environment, ADP should be fully capable of exceeding this 8% number. Building in a margin of safety to account for AI, though, does make the model more resilient. The dividend discount model analysis gives me a fair value of $367.20. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. This Dividend Aristocrat looks materially undervalued to me after its recent drop, but we'll now compare that valuation with where two professional stock analysis firms have come out at. This adds balance, depth, and perspective to our conclusion. Morningstar, a leading and well-respected stock analysis firm, rates stocks on a 5-star system. 1 star would mean a stock is substantially overvalued, 5 stars would mean a stock is substantially undervalued, 3 stars would indicate roughly fair value. Morningstar rates ADP as a 4-star stock with a fair value estimate of $305. CFRA is another professional analysis firm, and I like to compare my valuation opinion to theirs to see if I'm out of line. They similarly rate stocks on a 1 to 5 star scale, with 1 star meaning a stock is a strong sell and 5 stars meaning a stock is a strong buy. 3 stars is a hold. CFRA rates ADP as a 3-star hold with a 12-month target price of $300. I came out surprisingly high despite what wasn't an overly aggressive model. Averaging the 3 numbers out gives us a final valuation of $324.07, which would indicate the stock is possibly 21% undervalued. Here's the bottom line, guys. Automatic Data Processing Inc., stock ticker ADP, is running a high-quality, capital-light business model that generates high returns on capital without employing a lot of leverage. It has consistently operated at a high level for decades. Although AI adds a new wrinkle, its software remains deeply integral and integrated within clients' ERP. With a market-beating yield, a manageable payout ratio, double-digit dividend growth, nearly 50 consecutive years of dividend increases, and the potential that shares are 21% undervalued, this Dividend Aristocrat is one of my best long-term ideas right now for dividend growth investors.